Today I'm going to be showing you a liquidity target that has an 86% chance of being hit, and I'm also going to show you how to use it in alignment with my own personal strategy. So let's get right into it. Now, first things first, before we do anything, we have to figure out what direction we're actually going to be trading in, because if you don't know that, how are you ever going to identify a target for the market? So my personal strategy in identifying a directional bias is by using external and internal range liquidity. So when you first get onto the charts, maybe you go on the weekly chart or the daily chart, you simply want to see, is price moving to the upside like this, or is price moving to the downside like this? And whichever one it is, price is only going to be doing one of two things. It's going to be targeting internal range liquidity, which is old highs and old lows like this and this and these levels over here. That's external range liquidity. And the only other thing it's going to be doing is targeting internal range liquidity, which is inefficiencies. So, for example, these bullish FVGs, right? That's internal range liquidity. And these bearish FVGs, that's internal range liquidity too. So, you're going to identify, is price going up or down? Is it bouncing towards internal or external range liquidity, right? Very, very simple. Now, once you know whether price is targeting internal or external range liquidity, that's the direction that you're going to trade in, right? So let's say, for instance, we come onto the markets, price is bullish, okay? We see this, it's bouncing back and forth between external and internal. But when you look at the markets, price is down here, right? We've just targeted internal range liquidity. Now it makes sense to target external, right? So if this becomes our target, then we're going to be trading in this direction. So we're going to be looking for price to move to the upside. Let's say again, you get onto the charts and price is, back up here, right? For instance, okay, we've just targeted this external range liquidity, and now it makes sense to come back to internal range liquidity. We're simply going to trade in the direction of that target, right? So a bearish move to the downside to rebalance that internal. That's how I get my direction. The same if I am bearish, right? If we come into the charts and price is moving to the downside like this, I just want to identify where in the trend are we, right? Have we just rebalanced internal? In that case, we're going to be trading towards external. If we've just taken external range liquidity, right, and we're here, then we're going to be trading in the direction of the internal range liquidity. It's very, very simple. And then all I'm waiting for is confirmation that price is already going there. So if we're up here and we're looking to target internal range liquidity, I'm not going to try and catch the top. I'm going to wait for the 1 hour or the 4 hour to start building order flow towards that target, right? Same if we are all the way back here, right? If price is back here, this drawing's a bit messed up, but if price is back here at internal range liquidity and we're looking for price to target this external, I'm simply going to wait for the 4 hour or the 1 hour to build bullish order flow towards that target. That's how I get my direction. And now we can actually get into the high win rate target that I'm talking about. So for this high win rate target, we're going to be using previous day's high and previous day's low. So going over, years worth of data, I've worked out the stats here, and I urge you to actually go through the charts and see if this is consistent with, your own research. So here are the stats. There's a 13% chance neither previous day's high or low will get taken. There is a 10% chance both previous day's high and previous day's low will get taken. There is a 76% chance either previous day's high or previous day's low will get taken. And with those numbers, I worked out there's an 86% chance at least one of these two things will get targeted. And the way you work that out is if there's a 76% chance price will take previous day's high or previous day's low, but then there's also a 10% chance that price is going to take both, then both of those combined make an 86% chance one of them will get taken, because the way that I worked out the numbers is I categorized them either neither, both, or one of them, right? So these numbers here for both were separate to the examples there where one of them gets taken, right? So I can combine them both together, and that will give you the stat of 86% of the time previous day's high or previous day's low will get taken. And again, I urge you to go and check if these numbers are consistent with your own research. Now, if you want to identify these previous day's high and low levels on your chart, it's very simple. Just go onto the daily time frame, and whatever day you are trading, look at the day before that and mark up the high and mark up the low, right? You'll have previous day's high, and previous day's low, then marked on your charts. Now, if you want to find it easier on the intraday charts, you can actually just go into settings and then go on to events, and you can put on session breaks, and price is going to give you these lines, right? And that is 10 to 10. This is UK time, right? So market open to market close, and it splits it up very, very nicely, so you don't have to go on the daily chart. So then, like I mentioned a minute ago, you're not just going to be randomly targeting either previous day's high or previous day's low, right? You're going to use what I showed you with the higher time frame bias, so whether we're targeting external or internal range liquidity, and you just want to target, you know, whichever one is in that direction. So let me give you an example of this. So here on gold, okay, price retraced into, there's a weekly FVG down here, okay? If you don't believe me, go check it on your charts. There's a weekly FVG down there, and then price started to build bullish order flow, right? So we had this IFVG, and the target was now this external range liquidity, right? Because we went to internal, now we're targeting external. Let me just write it on there for you, and we're building bullish order flow towards that target. So when it comes to using these previous days high and low, because we're bullish, we know that there's an 86% chance of price targeting previous days high, right? If this was the other way around, right? Let's say we're looking at a bearish example. So for instance, here on the dollar index, price rebalanced this internal range liquidity, right? That daily FVG, and then we're bearish, right? And we're targeting external range liquidity, okay? We know there's an 86% chance price is going to take previous day's high or low, and we want to favor whatever the direction of our bias is. So we're going to be looking at previous day's low if we're bearish. So this daily low here had an 86% chance of getting hit on this day. This next daily low here, right, of this candle, that had an 86% chance of getting hit on this bearish day. So that's how we're going to use the targets. Now, let's talk about actually getting it in alignment with my own personal strategy, because, you know, the bias is good, the target is great, but you need to be able to know how to actually navigate the intraday and get your entries too, okay? So for this, I use something called daily cycles, right? Once I know where price is going on the daily and I have my target, I go onto the intraday time frame, so the 4 hour, the 1 hour, the 15 minute, and I look for what is called daily cycles. Now, what they are essentially are frameworks using the kill zones that allow me to time the expansion, because it's all well and good knowing, okay, the day is going to be bearish, but you want to know when that move is actually going to come in, and that is what the daily cycles do. So for these particular examples, for this particular video, I'm going to be sharing with you 2 daily cycles. Now, I personally use 8 of them, but just for the simplicity of the teaching, I'm going to show you 2 of them, and I'm going to show you bullish examples. So if you want it in the bearish context, simply just flip it around, and, you know, you'll have the bearish versions of the daily cycles. Okay, so the first daily cycle I'm going to be telling you about is called London protraction. So this is using Asia kill zone. We'll label this A because this blue box is Asia, and it also uses London kill zone, which is the purple box. So we'll label this L. Okay, so the way that this daily cycle forms is you're going to let Asia play out, right? We're not playing Asia. We're going to let it do its thing. And what we want to see is Asia building some kind of liquidity. So whether price consolidates and builds equal lows, or whether price simply forms an old low, okay, whatever it does, we just want to see Asia build some kind of liquidity, okay? And we're not engaging until London kill zone comes in. So what we're expecting London to do is move to the downside before running to your bullish target. So let's say we have a bullish target up here. Let's call it previous day's high. You're not going to expect London to run there straight away. You're going to expect London to take out Asia's low first. Once Asia's low has been taken out, that is a liquidity sponsor. That has taken the liquidity now to sponsor the move towards your target, right? So once you get that, you're expecting London to run to your target with aggression, okay? So once you see this sweep of Asia, down here is where you want to get your entry, and then this is the move that you're going to expect price to form afterwards, okay? And I'm going to get into how you go about getting your entry once I explain to you the other daily cycle, right? So that is the first cycle. And then the second one is called a New York continuation. And this one involves London kill zone which is the purple box again. I'll label this L, right? And it also involves New York kill zone. So we'll label this one N, okay? And it's going to be the orange box, right? And the reason it's these colors is because it's the same colors on my charts. So when we get into the real examples in a minute, you'll know the colors already. So we'll label this N, New York kill zone, okay? Now, this cycle is a little bit different, right? We're actually not trading London, or at least the move we're anticipating with this cycle isn't in London. We're using this cycle to anticipate an expansion in New York session, okay? And the way that this cycle forms is we'll get an impulse in London kill zone, okay? And we'll be targeting some kind of buy side liquidity. So again, let's just call it previous day's high. You're going to get a run in London that doesn't quite reach that target you was going for. And then at the end of London, in between sessions and at the start of New York kill zone, you're going to get a retracement. Okay, you're going to get a retracement back into the leg, ideally into some kind of PD array. So let's say we have a bullish FVG here. Once we get that retracement, we're in New York kill zone and we have this target that's yet to be hit. We can now expect New York to expand with high probability and high aggression towards the target, right? That's the anticipated move to the upside. So when price is down here, after we get the retracement, that's when you want to get your entry and you want to hold the trade to your liquidity target, okay? So that is the New York continuation daily cycle, right? And these are exactly what I use to be able to time the expansions within the daily candle very accurately, rather than just knowing where the daily candle is going to go and then from there it being a guessing game, right? It just brings a lot of accuracy into my trading. So like I said a minute ago, you want to get your entry down here, right? When you're waiting for price to expand. Once we've fit all the criteria, so the retracement into a PD array, or in this daily cycle, a sweep of Asia. Once you've done that and price is given that and you're expecting price to run, that's where you want to get the entry. And all we're looking for is a switch in order flow. So as price retraced or swept out Asia, price is going to be in a sell program on the lower time frame, right? Which essentially means forming and respecting bearish PD arrays, right? So bearish order blocks, maybe we respect bearish FVG as well, okay? And before we take the entry, we're looking for the lower time frame to switch. So maybe this is the 3 minute or the 5 minute or the 15 minute. I personally don't really use the 1 minute, but essentially we're waiting for this to switch. We're waiting for that order flow to turn bullish. And the way that we can tell is when price goes from forming bearish PD arrays like the order blocks, the FVGs, to now forming bullish PD arrays, right? So for me, my favorite form of this switch is known as a CSD, is a bullish order block. So I like to see price form a bullish order block. Then I know we are now forming bullish arrays and we're in a buy program. And then I'll look to literally take my entry off of any bullish PD array once we have this, okay? So maybe I'll enter off of the actual order block, stop loss at the low somewhere, right? Or maybe price will continue to build bullish order flow and I'll enter here, right, off of that order block. Or I'll enter here when we form some kind of FVG and ride it to the upside. It doesn't really matter to me. Once I get that first switch, right, that first order block formation, I'll enter off of any bullish PD array. So that's what we're looking for. We're looking for this, what I just explained, to take place down here. And then we're going to hold that trade to the liquidity target. That drawing's a little bit messy, but you're going to see now when I show you some real examples of how this works. Now, I almost forgot to mention to you that intraday model I just showed you. So the daily bias, the liquidity sweep, the daily cycles, the entry model. I've put all of that together into a free PDF where it's broken down into 4 simple steps. Now, if you want access to that free PDF, it's going to be the top link in the description. Like I say, it's completely free. There's even a flow chart for identifying the daily cycles included with it, and also some other tips and tricks for actually aligning price with time, which is very, very important when it comes to timing your expansion. So yeah, if you want access to that, completely for free, top link. Okay, so let's get into the first example, and I actually went over this a second ago in terms of bias on gold, right, when I was explaining the external and internal range liquidity targets. So essentially price retraced into this internal range liquidity, right? This bullish FVG. If you was to go on a weekly time frame, you'd be able to see it. And now we're looking for price to run towards external range liquidity, right? And it's a bullish target. So we're anticipating bullish daily candles, which means we're going to expect previous day's high to get ran out, right? And there's an 86% chance that previous day's high is going to get ran out. So I'm going to go ahead and mark up previous day's high onto the chart, right? So obviously we're playing the candle that follows this. So this is going to be the previous day's high up here. Once we have that target, once we have that bias, now we go onto the intraday and identify a daily cycle so we can time the expansion to the target perfectly. Okay, so we're here on the intraday, right? We're on the 15-minute time frame, and this previous day's high that I just marked up, you can see it's still intact. We haven't taken previous day's high yet, and we actually have these relative equal highs resting beneath it as well, which is a nice little touch. So we're looking for a daily cycle, a bullish daily cycle, to reach for that previous day's high. So this blue box, just like in the drawings, is Asia kill zone. Now, as you can see, Asia left behind this old low. Okay, so we have that old low there built up in Asia. And this purple box, the one that is barely visible because it's only just started, is London kill zone. And as you can see, London kill zone has taken out Asia's low. So this is the start of that London protraction cycle I showed you. Once London kill zone takes out Asia's low, we can anticipate price will turn around within here and run to the target, which in this case is previous day's high. So given that fact, where do we want to get the entry? Well, obviously we want to be able to catch the majority of the move. So we want to get the entry as low down as possible. So we're going to go on the lower time frames and look for that switch in order flow. Okay, so now we are on the 3-minute time frame. And like I explained a minute ago when I was talking about the entries, price is in a sell program moving to the downside through the liquidity. So we're forming and respecting bearish PD arrays. Like we have this FVG here. Price respected this bearish order block here. So in order for us to get confirmation that price is now turning around under this liquidity and is going to go to our target, we need to see that switch, right? So we need to see price now form and respect bullish PD arrays instead. So if I play out the next couple 3-minute candles, okay, you'll see price actually does exactly what I just said, right? We push to the upside and we form a bullish array. These last 3 down candles get closed above with this candle here, right? And that forms a bullish order block. Okay, so we've formed a bullish PD array. So we're now in a buy program on a 3-minute. We've switched the order flow to bullish. So that's the signal, right, telling us price is turning around under Asia's low. Now we can be very confident London's going to run to the target. If I play out the next candle, I believe, yeah, so we form an IFVG as well. So when it comes to my personal entries, I'm flexible with it. Once we get this CSD, I'll enter off of whatever bullish PD array. So my personal entry was off of the IFVG and my stop loss went at the low. And simply the target is previous day's high, right? Because we know there's an 86% chance previous day's high is going to get ran to. We have the daily cycle, we have the entry. That is the play, right? It's a high probability move. So if I play this out, you'll see we respect the CSD and we start to run to the upside, right? We respect my entry. And, you know, even if you didn't take that entry, like I just said about being flexible with it, you could have entered again, right? And I actually did. I put my position at less risk. So I moved my stop loss here once we reacted away. And I entered again off of this propulsion block here. Okay, so that was my second entry. And I'll actually put the executions up on the screen, right? So you can see that I took both of the entries. This stop loss was here. And again, we're targeting previous day's high, which has an 86% chance of getting hit. Okay, and this is the beauty of the daily cycles, right? We knew we was expecting the daily candle to run. But the expansion, right, we want to know what session is going to run in, right? We want to be able to know down to, you know, the space of an hour or two, when is price going to hit the target. And that's what daily cycles does. If I play this out, you'll see the London protraction cycle played out perfectly. It was London kill zone that ran to the previous day's high, hitting both TPs, right, fulfilling that previous day's high target. So now let me show you an example using that New York continuation daily cycle. So this next example is on GBP USD. And once again, we want to go on the daily and identify, are we bullish or are we bearish? So we know if we're targeting previous day's high or if we're targeting previous day's low. So as you can see, price is printing consecutive bullish candles on the daily chart. On DXY, you can see that price is running aggressively to the downside towards this old low down here, which would be considered external range liquidity. So the fact that DXY is running towards a clear external range liquidity target means that we can buy GBP USD, and that the draw on GBP USD is bullish until DXY reaches that external range liquidity. So we're anticipating a bullish day, which means for the target, we're going to be looking at previous day's high. Okay, previous day's high in this example has an 86% chance of getting hit. Okay, so now we have the target, we have the bias, we just need to identify one of these daily cycles. Okay, so we're now on the intraday. This is the 1 hour time frame, and we're looking for a daily cycle so that we can time the expansion to previous day's high with high accuracy. So looking at London kill zone, which is this purple box here, okay, you can see that price took out this old low, and then we had a bit of an expansion to the upside, but price never reached the previous day's high target, right? The previous day's high target is still intact. So given this information, we can look for a New York continuation. So we're looking for a retracement, and then for New York kill zone to open up, give the entry and run to the upside. So if I look at the timing, this here is 12 o'clock. So this is the start of New York kill zone. We got the retracement. And in terms of buy zone, like a PD array, because that's what I said, right? We want to see it retrace into some kind of PD array. We have this IFVG because price closed through this FVG here. You could also say we have this immediate rebalance level. You could also say potentially that we're within this order block here, right? Because these are all consecutive down candles that got closed above. That's an order block. So we have the PD arrays to buy from. We had the retracement in between sessions. We still have the target intact. There is no reason why we shouldn't see this expansion now play out in New York kill zone in alignment with the New York continuation cycle. So once we've got that retracement, we want to get the entry as low down as possible. So we want to enter when price is down here before price runs to the target. Now, if I play it out, you'll see that the following 1 hour candles expanded from this zone and targeted previous day's high. If I put on New York kill zone, right, you can see it was New York that got the expansion, right? It was New York that actually pushed price to the target, right? Which just shows you how useful the daily cycles are, right? If you can time the expansion down to a window of a couple of hours, you're going to be able to trade with very high accuracy. You didn't see the entry just now because I can't go on anything lower than the 15-minute here, but I have a picture. So this is what price looked like on the 3-minute time frame. Okay, this is a screenshot from when I actually took this trade, and this shows you the entry, even though I couldn't show you on the chart. So even though it's not marked up, we had these last 3 down candles here. Okay, they got closed above by this bullish candle, and that formed a bullish order block. So we went from bearish, respecting bearish arrays, to forming a bullish order block, which is that CSD that I want. And then I can enter off of any bullish PD array. We also formed this IFVG, right? There's an FVG here that got closed through. So we have an IFVG. We also have a regular FVG between these 2 wicks and an FVG down here. So I simply entered off of the highest one. My stop loss went down here. And yeah, you can see price tagged their entry and ran to the upside. So like I said a minute ago, you want to get in as low down as possible as soon as price gives you that 3-minute, 5-minute, 15-minute CSD, and then yeah, hold the trade. Now those examples I just showed you use 2 different daily cycles, but I actually use 8 of them. So if you want to learn them all, consider joining the Daily Cycles program. You can start completely for free because there's a 7-day free trial and you can cancel it anytime. If that's something you're interested in, it will be the second link in the description. And it also comes with 7 in-depth trading courses on everything that I personally use on the charts, whether it's intraday, higher time frame, psychology, power of 3, into market analysis. If I use it on the charts, I've put it in the program. So make sure you don't miss out on that. 7-day free trial is the second link in the description. So that was the video. I hope you found value in it, and I'll catch you on the next one.